Hi, I'm Tom Lydon here in Hollywood, Florida at the Inside ETF conference with Luke Oliver with DWS. Great to see you, Luke.
Yeah, you too.
So, equities, fixed income, alternatives, all play a role in the portfolio. What about currencies these days? Are they more and more affecting portfolios?
They always have done. I mean, we look at these, the 10 years from 2000 to 2010, everybody was increasing international allocations, but all those returns were coming from the dollar getting weaker over that period. So we then had this phase of people realizing currency was important and hedging currency, but people took that very tactically, and we've always held this approach that being currency hedged is very much a strategic decision. You're reducing volatility, you're earning carry if the US rates are higher than the developed world, and you're also taking out and getting a pure play on those equities and not involving a risk you didn't really anticipate in the first place.
Right, so as far as looking over the next 10 years, first of all, today, advisors and individual investors are less allocated overseas than they should be, with 55% of market capitalization being outside the US. So, but there's also great value there. And as advisors start to see more value and allocate more overseas, what can a currency hedge strategy do to help?
Well, I mean, we found that even if you just partially currency hedge, you almost get an oversized volatility dampening from doing that. And so volatility reduction comes almost as standard with almost every currency pair. If you currency hedge, you take out volatility.
Yeah.
The fact that US rates are positive and most European, Japanese, UK, zero or negative rates, that means that you're actually earning that differential. So you're actually getting paid something in the region of 200 basis points to currency hedge. So if you're being paid to do it and you're reducing volatility, it really is something that we can't stress enough how important it is for people to consider having some portion of their international currency hedge. It's a safer way to do it. It can really, when I say safer, it can reduce volatility in most cases.
So the fact is, if you're investing or you're allocating to a diversified ETF outside the US or specific regional area, and you're not currency hedging, you're betting on the local currency.
That's it. When you buy an international equity, you buy those equities, which is what you're really trying to do, but you're also shorting the dollar to do that.
Yeah.
And so people don't realize that by investing internationally, they're also betting against the US dollar. And I think that while the dollar doesn't always strengthen and the currencies are volatile and unpredictable, so by hedging them, you're taking that risk off the table. And as I mentioned, right now and for the last few years, you've been able to get paid for that taking less risk. And it's very rarely does that happen in a fund.
Well, advisors need to be thinking about it. As always, Luke, thank you.
Thank you.